It's my great pleasure to welcome all the participants to the panel. And we have what we think is a very interesting topic, active and passive funds, emerging issues. And we have an absolutely fantastic panel. Kumar is a professor of finance and the Maguire Chair at SMU. He's also academic director of the Maguire Energy Institute. He's an inaugural member of the Securities and Exchange Commission Fixed Income Market Structure Advisory Committee. He was the best 40 business school professors under the age of 40 in the ranking of business school professors. So, he's also on the editorial board of JFQA, besides all his other publishing and other experiences. We have Jonathan Brogard. He's professor of finance at the University of Utah. His research interests are in market structure and empirical analysis. He works a lot in automated and high-speed trading, and sometimes it gives me the impression that he works in machine trading, but he is truly a machine in the way in which he produces his research. So, and that's in a very, very short time. He's got an outstanding publication record. And this year he had 3 top journal publications for which he got a special award, an RFS Best Paper Award. He runs a step fund, hedge fund. It is in his spare time, Stepwise Investments, LLC. And is professor of finance at Imperial, former president of the European Finance Association, and did an outstanding conference in Poland. Given my long European Finance Association, therefore I know him extremely well. His outstanding publication record, not just in finance, but also in econ, and he was the editor of the Review of Finance, editor at JFQA. And finally, we have Sanjeev Shah, who is an incredible fintech entrepreneur, an alumni of LSE, worked with Merrill Lynch for 14 years, and then co-founded Benchmark Asset Management in 2001. And that company has pioneered passive quantitative investing in India, introduced a lot of these investment products, India's first ETF, which was on the Nifty, the first money market ETF, maybe the world's first money market ETF, and India's first commodity ETF. And then when he sold it to Goldman Sachs, his company, and then he worked with top leadership with Goldman Sachs for some time, and helped pitch the idea of disinvestment through ETFs, and has taken that forward. Now he runs something called One Pay and One Move. I don't know very much about them. I'm sure he would like to talk about it in his spare time. So today's panel, we have identified 3 issues around which we plan to discuss things on the panel. We have, the first one is liquidity mismatch, when funds hold relatively illiquid assets, but promise daily liquidity to fund investors. Second, given the popularity of ETFs, what are the spillover effects on cash, equity, bond markets? And third, are there any implementation or other issues that come up with passive indexing strategies in both equity and bond funds? So we don't have all day, and therefore I'm lots to talk about. So I guess I'll hand it over to the panelists, and I first invite Kumar to kick off the discussion. And it's free form, and please feel free to add in your thoughts on the chat. We're not using Slack; we're just using the Zoom chat. And also, once all the panelists have done, we would. I'm hoping we'd have a spirited discussion on the issues. Kumar.
Thank you, Pradeep. Thank you, Susan, and other organizers of the Emerging Market Conference. Really a pleasure to be on this panel with Marcin, Sanjeev, and Jonathan. Um, as you know, we had a period of very high volatility in March of this year, and periods of high volatility provide an opportunity for us to go back and look at design of securities and design of instruments. So I would like to share some evidence that has come up in academic research on the optimal design of sort of mutual funds and ETFs, and whether there is room for improvement in that context. So to set the stage, let me just very briefly present my views from the perspective of liquidity of the three types of instruments. So you have the mutual fund that holds certain securities. You have the ETF that holds, again, a portfolio of securities. And then you have the underlying securities. These could be stocks, these could be bonds. Sometimes these are derivative securities such as futures. And the underlying security, stocks, for example, they trade intraday on organized markets. Fixed income securities trade intraday on over-the-counter markets, typically intermediated by bond dealers. And so you observe a market price intraday. ETFs trade on organized exchanges intraday. So you observe the ETF price intraday. And you have mutual funds that do not trade intraday, which interacts with investor inflows and outflows at the end of the day. So there's no intraday trading. And there is one transaction price that occurs, which is the net asset value. And this NAV is either based on the market price of the portfolio of securities that is observed from the market, or it's based on an evaluated price when the security does not trade. So this is the sort of the structure of these three types of instruments from the perspective of trading. So let me first focus on mutual funds. So the mutual fund has a policy where redeeming investors receive the net asset value at the end of the day. So the problem with the net asset value that is used is that it does not capture the cost of liquidation. So if an investor puts in a request to redeem a mutual fund, the mutual fund gives them the NAV, but they may actually sell securities to raise cash in subsequent days. So the cost of liquidation does not get reflected in the NAV. And when the mutual fund holds liquid securities, for example, the S&P 500 index stocks, the liquidation costs are small, and the end of the day NAV is fine because it does not hurt investors who are continue to hold positions in the fund. But the problem comes up when mutual funds hold illiquid securities. For example, if you think about corporate bonds or small cap stocks where the cost of transactions are high, the fund, when it receives a redemption request from investors, usually what it does is to raise cash, it sells its most liquid assets first. And therefore, if you look at a portfolio and it's selling its liquid assets first, the fund's holdings become less and less liquid over time, and they're associated with higher and higher liquidation costs. So if you have a period of persistent redemption, then what happens is that these liquidation costs as well as the liquidity risk gets transferred from investors who are redeeming to other investors who are keeping their money in the fund. And this is an issue because over periods of market stress, it results in wealth transfer. So there's a very nice JFE paper by Ite Goldstein and co-authors who use the idea of a bank run and a theory of panic to make the point that when a large shock hits the system, there is a large first mover advantage in funds that are holding illiquid assets. So what rationally investors in that mutual fund should request a withdrawal to get out so that they are not the ones left holding the bag. And so this leads to an amplification of withdrawals from illiquid funds holding illiquid assets when there is a large shock. And there's some support for this particular theory based on past data. For example, if you look at bond funds, the flow performance sensitivity tends to be particularly high when there is a negative shock. However, to test this theory properly, you really needed a large shock. And for the last 10 years, as you know, there's been a lot of central bank intervention. Markets have been very calm. So when March 2020 came in, it provided a really nice experiment to test this. So let me tell you a little bit about what research has found on bond mutual funds where the underlying securities, which are bonds, are illiquid. So first of all, in February and March of 2020, it was a large shock. I mean, mutual funds, the cumulative outflows from bond funds was almost 9% of assets under management, which is fairly large. If you look at the June-July 2013 taper tantrum, which was one of those large volatile periods, it was only 2.2%. So 9% during those few weeks was a fairly large shock. And what the analysis from data tells us is that the illiquidity of the fund actually amplified these withdrawals. So what you find is evidence of investor panic, which is accelerated or abnormal withdrawals by fund investors. These are particularly observed in funds that were holding less liquid securities. So this is consistent with the theory that was put out by E.T. Goldstein and co-authors. And I think things would have been quite worse if not for the Fed coming in and making a massive announcement on March 22nd for large-scale intervention with asset purchases. So this stopped the outflows, it calmed the market. But the question is, what's going to happen the next time, right? Is the Fed going to come in every time? So the policy recommendation that comes out in terms of the design of mutual funds is swing pricing, which mitigates these run dynamics. So swing pricing occurs when a mutual fund adjusts the NAV of the fund in order to pass on the costs of trading to those that are buying and selling within their accounts. So it's designed to protect the longer term shareholders from having the value of their accounts eroded by the transaction activity of others within the fund. And this has been something that has been used in the UK, and perhaps Marcin can speak to it. There's been some academic work done related to that. And what evidence from UK suggests is that it has significantly reduced these redemption risks and amplification from illiquid securities during stress periods. So I think this is one of the sort of policy recommendations that comes out for the US market and other markets, where there have been some discussions of swing pricing, but really it has not been incorporated in terms of the design of mutual funds. Then, of course, the Fed measures to calm the markets, on March 23rd, stopped these fund outflows. The markets recovered, but really we need to understand the new Fed policy as a financial stability tool. Is it beneficial in the long run? Will the Fed show up the next time? Does it create winners and losers, etc., right, when central banks intervene? So I think this is something that I think we need to further understand. From the perspective of exchange traded funds, again, the March 2020 provided a nice experiment to study whether ETFs are playing a destabilizing role when markets are stressed. This is something that academics and regulators have been discussing for a long time. And the main mechanism that regulators are worried about is the following. ETFs have become very large. And in many cases now, ETFs are no longer sort of the plain vanilla ETFs. They tend to be implementing certain specific strategies, and they tend to invest in illiquid securities. So in a crisis, if the investors exit these ETFs, what you're going to see is selling in these ETFs. That's going to cause a temporary price decline in these ETFs just because of the liquidity shock. And when the ETF price declines, then it's going to trigger arbitrage activity. So this particular shock in the ETF market will result in price disruption in the underlying securities. And to the extent that the underlying securities are illiquid, it's going to cause further destabilization in the underlying security. So again, this was something that we could study in February and March of 2020 because there were large cumulative outflows from ETFs, and transaction data suggests that there was large selling by investors in these ETFs as well. But overall, the data suggests that the ETFs traded really smoothly. They did a really good job. They withstood volatility in March quite well. They stayed open, they stayed liquid. They allowed participants to take or remove exposure without trading the underlying securities, which are more illiquid. And therefore, they acted like a shock absorber, and they contributed to price discovery. So overall, the ETFs, I think, out of March 2020, the COVID shock came out looking quite well. The destabilizing effects were not really observed. However, some problematic patterns were observed. So for example, ETFs experienced notable divergence or discounts between their market price and the NAV. So remember that the market price of the ETF is a price at which the ETF is trading in the secondary market, but the ETF has a portfolio of underlying securities, and you can value these underlying securities because they are trading as well. And so that is the NAV. And so what you observed was there were significant notable divergences, and in particular, market prices of the ETF was lower than the NAV. And so the question is, what explains these divergences? There are two explanations. One, the ETF is really the correct price discovery vehicle. That's really where prices are being discovered, and the NAVs are stale prices. Or the alternative explanation is that these ETFs are getting dislocated because there's secondary market trading going on. And when you have a lot of selling pressure, the ETF price moves down, whereas the NAVs, because they reflect the intrinsic value, they do not. And so we have observed these notable divergences between the market price and NAV. And I think we need to better understand, what drives these divergences, because both the ETF market price and NAV represents real prices that investors participate in. For example, in the case of many fund families, you have an ETF and you have an identical twin mutual fund that holds an identical portfolio. And suppose the ETF trades at a discount to the NAV, which might suggest that the NAV price is reacting too slowly. This means that some investors who bought the mutual fund essentially overpaid, while those investors selling the fund received more for their sale than they should have. So this brings up some policy questions about how retail investors should be protected. Should mutual funds halt purchases and redemptions when market conditions are very volatile, because you don't know what the real price is, and so you don't want to allow inflows and outflows to occur at prices which are incorrect. So overall, the ETFs, I think, did a really nice job during the COVID-19 crisis. It does not appear that they played a destabilizing role, as has been feared by regulators for the last decade as the assets under management of ETFs increased. But at the same time, there are certain issues that have come up that I think will be further examined by regulators. So these are some interesting design issues that have come up in the context of liquidity and how we should think about mutual funds and ETFs. With that, Pradeep, I turn it back to you.
Thanks, Kumar. I think before we go on for discussing, let's go on to Jonathan next. And Jonathan, would you like to give your points?
Yeah, let me, I have some slides. Can you hear me okay?
Yeah, you can just share them if you want.
Okay. They are these slides. Share. Okay, can everyone see them? And are they now in, oh, there we go. Can you see the slides?
Yeah, we can.
Great, okay. After a full semester of teaching, I finally figured out Zoom, so good. First off, thank you to Pradeep and the organizers for inviting me to be on this panel. And I've been thinking about ETFs for a couple of years now. I don't have a lot of work in the area, but I stay up to speed with the literature. The paper that I have in the area is published last year, but I think it's really relevant right now thinking about the role of ETFs, because we aren't the first to do a lot of these things, but I have some nice the figures that I'll show you. And then I'll point out where we make our little contribution to the literature. I think something that I want to start out by saying is that Kumar is spot on with regards to, we need to think about, what is the effect of the ETF specific infrastructure versus just passive retail, passive investing or retail investing, and distinguishing those two is really hard. This paper actually, even though it's we're going to use ETFs as our instrument to study, it really is more about just passive investing. So I think I'm not, what I show you isn't going to be able to distinguish those two, but it is important to keep that in mind. This paper is co-authored with Matthew Ringenberg, my colleague at Utah, and David Sovic, who's at University of Tennessee now. So what we were looking at was the commodity markets, because in 2004, you can sort of see, I highlighted it with this green line. That's sort of what's considered the financialization of the commodities market. It doesn't happen overnight, but it's the start of this large increase in open interest, the sort of directional position where there's people taking bets on whether commodities like energy or agriculture are going to increase or decrease in the future. And so before that, pretty much the market was made up of the market makers and hedgers and occasionally a couple of speculators, but there wasn't a lot of retail investing. And then what happened was in early 2000, a paper came out, I think it was by some Yale professors, saying how commodities were a great hedge and a great way to add diversification to your portfolio. And shortly thereafter, ETFs were introduced on some commodity indices, and you saw the trading volume on these ETFs skyrocket. And I'll show you some data on that in a second. So this is just a little bit more detail on specific commodities instead of whole groups of them. There was just a big increase in the open interest for these different assets. And again, 2004, it's not like a clear discrete cutoff, but that's sort of what is termed as the beginning of the financialization of the commodities market. This is what I think is probably the most interesting graph and one most relevant for ETFs. Is there's sort of a handful of products that most retail and institutional investors who don't invest directly in the futures but want exposure, there's a handful of products that they use. And they're sort of based off of one of two indices, either the S&P GSCI, the Goldman Sachs Commodity Index, or Dow Jones AIG. I think it's an agricultural focused index. But you can see that the volume in the ETFs that track these indices went from 0 to let's see if I'm reading this correctly, on the right hand side, over $250 billion within 4 years. So there's this huge inflow into commodities via passive investing and ETFs in particular. And the question that we're really interested in is what does this do to the firms? Other people had looked at, and I'll summarize what they found in terms of what this did to sort of the underlying assets. But what our specific focus was what happens to the behavior of the firms themselves that either produce or use these underlying commodities that now experience this huge influx of investing. The price, whether or not this inflow of passive investing influenced the price is debatable. There's a number of papers on both sides for the financialization of commodities, and I think more generally on the role of ETFs on whether or not they have an impact on prices. So that's pretty debated. But in terms of their impact on volatility, there's this Henderson, Pearson, and Wang 2015 paper around in the financialization setting argues pretty convincingly that yes, they did exacerbate volatility. In the, what I'm talking about here is for this commodities financialization, but I think all the points I make here should be somewhat generalizable to like equity ETFs. So Zahi Ben David has a similar paper looking at ETFs in general, so mainly focusing on like S&P 500 ETFs and small stock ETFs, etc., and comes to a similar conclusion that the increase in ETF trading results in greater price volatility. So this is not our contribution, but it's sort of a little background on the literature. Here is, you can see there's a large increase in prices that happened, and they really ramped up during the financial crisis. And then when the financial crisis hit, they dampened way down. A lot of this is argued due to the rise of China right now. You can see China coming in and consuming a bunch of resources. And there's variation in volatility, and it doesn't line up necessarily with prices. So, one thing that we did was look at whether or not the volatility and the price changes are just highly correlated with each other. And so we do a really simple test. As you look at price changes in the 3 years prior to 2004 and the 3 years following 2004, for commodities that are in the Goldman Sachs index. The Goldman Sachs index has roughly, I think it's 27 or 29 commodities in it. And there's a bunch of other commodities that have futures on them that are not included in the index. And so those commodities are our control group. It's really nice because those commodities are, impacted likely by the similar types of demands from end users due to the rise of the economy and of certain countries, but they aren't subject to the same shock of being in the ETF of the Goldman Sachs Commodity Index. But what we see is that both types of commodities, those in the index and those not, are both impacted in terms of their price, pre and post 2004. But when we look at price efficiency, which is sort of another way of getting at volatility, except we care more about whether or not these prices follow a random walk relative to whether or not they're more or less volatile. The two are there's a linkage between the two. It's not perfectly one for one, but they're we think the price efficiency is the more interesting measure for our points, because it's something about the efficiency of information in those prices, and we use the Howe and Moskowitz 2005 R squared measure. A higher R squared means less efficient. We see a big shock for those commodities that experience the ETF inflow, and we see no shock for those ETFs that did not experience the inflow. And so this is sort of our spin on, yes, there was a effect on commodity prices, especially their price efficiency, due to the rise of ETF trading and due to the rise of passive investing in commodities. Now, what we really focus on is, let me skip this slide, is how firms behave. There's maybe until 10 years ago, there was a big debate about whether or not the stock market was just a sideshow and did it really matter for the overall working of the economy. It's still an interesting sideshow, but it's more important if it matters for the economy. And so what we were doing at this time was showing that ETFs have an impact on the real economy. And the idea was this: if you see a rise of ETF trading, and that's associated with a decline of price efficiency, then that means prices have more noise in them. Commodity prices have more noise in them. And if managers of like Hershey's, that's the chocolate, I was gonna say chocolate factory, the chocolate producer, if Hershey's managers now see prices for cocoa being more noisy than before, and they don't realize they're more noisy, they could infer that a higher price of cocoa means there's going to be more demand for chocolate, like they used to before there were ETFs. But when you have ETFs, that signal becomes distorted, it becomes noisier. And so managers are relying on this price signal that maybe isn't as precise as it used to be. And so they end up making decisions about how to run their business, how much cocoa to buy, how much chocolate to produce, and in the end, make an incorrect inference about what they should be producing, about the demand that their product is going to face. And as a result, they misallocate resources. Hershey prices here, cocoa went up more than it would have otherwise in my example. As a result, the Hershey managers produce too much. They incur costs. They have that they wouldn't have otherwise. They have a decrease in profits, and their performance becomes more volatile. So we were trying to link in this paper the rise of passive investing via ETFs and whether it affected the performance in terms of like profitability, return on assets of the underlying firms that use the prices from the market in their production demand function. And we found just that. That these firms were in fact impacted. Now, I'm going to wrap up here in a second, but before I do, we show a negative impact of ETFs or passive investing on the economy. If you were to ask me overall, what are the welfare implications? I would say our one small slice of the question, we show a negative effect. I would say if you looked at the whole impact of ETFs, it is on net strongly positive. It doesn't mean there aren't kinks that we need to work out. So, Kumar brought up some really good ones. The paper that I just presented shows some kinks due to the pricing signal. But overall, the ability to let investors diversify and to avoid mutual funds that charge 1 to 1.5% fees has been on net a huge benefit. There are potential negatives. For example, now it's really easy to trade. I think John Bogle, before he passed away, is quoted saying that, ETFs has actually been, there's a downside to ETFs, which is now retail investors can day trade on portfolios instead of individual stocks. And that's not sort of the purpose of them, but overall the positives outweigh the negatives. So with that, let me wrap up so that we can hear from the other people on the panel.
Thanks, Jonathan. We now go on to Sanjeev. Before we go to Sanjeev, I just wanted to just add on mention one thing before I forget in relation to Kumar's issue about the point he raised about the value of the fund and the price at which it's trading. Now, in relation to the cost of illiquidity, the cost of illiquidity is not just the trading cost of illiquidity. I just wanted to mention that. It's also the fact that we can't divorce it from the differential staleness of prices. So illiquidity means that some stocks in an index that one is trying to track, some stocks would have to lead the index and some stocks would have to lag the index. And because of that fact that information gets incorporated differentially across different stocks, the value at which it is being settled at the end of the day for a mutual fund or in an ETF whenever they rebalance, that value is not necessarily its true value. So it's not just the cost of trading, it is the deviation of the settlement value from its, for this pricing error, if you like, relative to its true value. And that will get corrected only over time, like over 1 day or 1 hour or whatever is the differential period of time. So that is something which is usually not considered in cost, but I just thought I'd mention it before I forget in relation to the point that Kumar had first made. Now, Sanjeev, would you like to take over?
Sure, thanks, Pradeep. Thanks, Jonathan. Thanks, Kumar, before me and Marcin later. And thanks, Susan and Ajay, for organizing this. Just to give you a perspective in terms of the Indian market, I thought just talk about the active market first. What's happening in the active market in India is the markets, especially the mutual fund market, has actually constructed pretty well in terms of the liquidity. So you have funds which basically give you liquidity only once a day. Possibly, some of them only do once a week, some of them only do once a quarter, and some of them actually only do on maturity. So they actually have taken in the illiquidity risks and ensured that basically, it takes care of the underlying market conditions. So that's been kind of a little bit much more evolved, I would think, than most of the other markets who try and give liquidity all across. You can't do that in passive, So what happens in passive in India is, and I think it happens everywhere in the world, is that the construction of the index actually takes care of the illiquidity in a sense. Because what happens then is basically the illiquid stock which you would have typically in your portfolio is, it takes care of, it's only minuscule in terms of, actually, let me close the door. Everybody liked the emerging market conference so much they actually started frying crackers. So the illiquidity is taken care in terms of the percentage of each stock is very low, which is illiquid. So if you look even at most of the ETFs which are floating in India, typically you would have most of the stocks which are liquid, and if they are illiquid, there's a limited amount. But we had constructed a completely new index, and we had a very good experience in terms of how illiquidity of underlying changes with the volumes in the market. So we had something called the bank index, and we had a bank called Corporation Bank. We had a 12 stock index, so the weightage in that was small in terms of the other stocks, but not trivial. It was 5%. The volumes on that typically, on a day where trading was, not more than about $100,000. But, we had sometimes flows of nearly close to about 30, 40, $50 million, which would mean 5% of that would mean nearly about 20, $25 million. You'd be surprised that, basically it had futures. The prices obviously, changed quite a lot comparatively, but over a period of the next 3-4 months, funnily, the volumes in the underlying actually came up enough for us to trade 30, $40 million. So that was a pleasant experience in terms of, how our ETF was actually changing the dynamics of liquidity for the underlying stock. The other experience we had was of when we did the CPS ETF for the government, the underlying stock typically didn't trade because the government stocks didn't trade. But when we came out with the ETF, we had actually given a discount of about 5%. Arbitragers came in and actually provided huge amount of liquidity to that. And because of which now the government has actually done a total divestment of close to about $15 billion to this instrument. Now, what has happened?
Could you explain to you how disinvestment and ETF, I find it difficult to see the relation between what
Sure.
ETF and the concept of disinvestment.
Yeah, so the initial idea was that basically government has a lot of stocks. So can we actually replicate the stocks of the government of India in a manner which is similar to Nifty in terms of the risk profile? Now, obviously, government didn't have many stocks, including basically the consumer stocks never existed with the government of India. But they, in willy-nilly in 2001, actually picked up some stocks thanks to UTI. They had, L&T, and they had ITC and their Axis Bank and a few more banks, which actually allowed us to have a correlation with the Nifty to be very, very close. The government eventually didn't buy their idea, but they said, why don't we do the normal ETF? That's when we thought, okay, this makes sense. Government companies as such don't have a thematic value. Government companies as such don't, are not the high value investments which most of the retail market or the normal market is making. But we thought, structurally, can we come up with an idea that, basically we can actually create a basket of securities so that when all of them go into the market, one stock doesn't have a lot of selling pressure. So when the government was doing, kind of FPOs or, open market transactions, you had only one stock which was coming, say, ONGC or whatever. The market knew it. Market used to basically, press down the price substantially by 5-10%. But through ETF, we actually brought down the discount. And I think Renuka has done some research on that. Discount to nearly not more than about 3-4%. Overall, which typically the government was ending up at 7-8%. So that was the idea of doing that ETF, and it worked well because we saw that the arbitrages and market makers definitely come in when they see profits, which is organized profit. Let's put this properly done. And now I think the government, the last I know, has done about $15 billion worth of divestment through that. Now they can't do it because most of the stocks are close to 51% unless you change the parliament and all that. So that's why they've stopped. But that was the context in terms of how we did the ETF. So just to give you an idea, how ETF actually helped change the dynamics of the liquidity of the underlying stock. So that's one of the examples I wanted to talk about. The other thing I wanted to really talk about was in March, and it's funnily, Kumar talked about the fact that ETX actually, did very well. So in India, there was actually a gap between the NAV and the trading price. And that gap didn't happen because there was illiquidity on the underlying stock, because there was lack of capital for the market maker, for the authorized participant. So, basically there was so much of demand coming through, the authorized participant just didn't have the money or didn't plan for that money for that particular day. And that's why, basically he couldn't supply the stock. So, the markets did well, but the stock of money didn't do well. So very interestingly, the ETFs actually did way better than, anybody anticipated in market conditions, which one would think it wouldn't play out. The other thing, I want to talk about is how ETFs also, so we actually came up with the idea for gold ETF, which is kind of first in the world. We couldn't do it because of a lot of reasons in India, but our idea was that basically we would be able to actually buy gold in a futures form or a deposit form, and provide real-time liquidity and real-time prices to people. Eventually, RBI allowed us to do it in form of buying the gold, underlying gold, but we could actually marry the underlying market, which was a physical gold market, to the securities market, which was NSE. And the price for gold at any point in time in that market was very, very close, and the arbitrages would come and actually play out if it went out of whack. So, just went to see that basically we could actually marry two markets, completely different underlying market, liquid. One has to be real that, the gold market in India is very liquid, and the NSE securities market, and we could actually marry them both and provide liquidity for gold in securities market. The one area which we tried but were not successful was the bond market, because the bond market liquidity of the underlying liquidity is so terrible that even though we actually thought through, we conceived a product, we gave it to the bank, to the SEBI, we eventually decided not to launch it because, and the SEBI never gave us permission also, to be honest, was that, basically the problem in terms of, how we would basically have the liquidity in the underlying bond market. That's what Kumar was alluding to also. And we actually didn't see a problem in terms of, selling those securities, but in terms of creation, because in India, how do you create those securities for corporate bonds? And in terms of the government securities, the difference between the off the run and the on the run security was so huge that it actually creating a drag on the fund. So, we had very interesting experiences on the ETF market to come back to the issues which, Pradeep had listed down. In terms of illiquidity, I think, the active market has taken care of it in India. In terms of, the passive products, typically the structure of the indices takes care of it. Or you don't end up doing, if you have illiquidity, you will actually go to the structure, which is like a mutual fund structure, which is one price. And I'll give you an example. We want to do ETF of 500 stocks, but we didn't do it because the liquidity in the bottom 350 was very low. So we converted it into a normal index fund, wherein the tracking error is high, but you don't have to worry about the underlying liquidity because at some point in time you will get liquidity. So the market does take care of it, and that's what we observed in India. Thanks.
Thanks, Sanjeev. That's very helpful. Marcin, do you want to go next?
Yes, thank you, Pradeep. I hope my slide has seen. I think this must be the most asked question over the last couple of months. Can you see my slides? I feel like it shows up in a lot of presentations that I have participated in. So I assume that everyone can see my slides. So thank you very much, everyone, for participation. And most of all, Pradeep, for having me being part of it. So I think it's actually very nice that I come last because what I think I'm trying to do with my presentation is a little bit integrate different views that I have heard so far. So we've heard some views from Kumar and a little bit from Jonathan on the passive kind of aspects of asset management, and Sanjeev has touched quite a bit on the active side. And what I want to talk about is more the integrated world in which both of these two parties actually coexist. And what I'm going to actually talk about is less about the microstructure effects that are related to these particular players, but more some kind of secular effects that we may actually expect to see in the market. So I'm going to talk effectively some kind of model or some kind of framework in which active and passive investors interact with each other. So of course, there are a lot of things to like about passive investors. I don't need to list those. But I think what's also important is that in the spectrum in which we think about passive investors, we need to actually understand that they are just part of something that we call the market clearing. And there are some other investors out there who actually interact with these passive investors. And what I think is essential for us is to understand what's the effect of different types of investors in this world on both their strategic incentives, but also the prices that are actually established in some kind of equilibrium. And the question that I want to talk about a little bit more today is the question of informational efficiency. I mean, Jonathan talked a little bit about informational efficiency, so maybe my talk today is going to be a little bit more of a follow-up to what he said. So I think at this point, it's fair to say that one of the important aspects of informational efficiency, of course, is some kind of notion of welfare. We want to think that, that the more efficient the allocations of capital are, the more kind of welfare we can maximize. But even at the individual companies level, we can think about the impact on cost of capital. And of course, that kind of feeds back to a lot of other decisions that happen inside the company. So what I want to talk a little bit about today is based on two papers that I have written over the last couple of years. So one is a theory paper and the other one is an empirical paper, but roughly speaking, they deal with the same kind of issue, which is what's the effect or the relative effect of active and passive investors on some kind of notion of price informativeness or market efficiency. And in the theory paper, we are going to talk a little bit about some kind of general equilibrium and notion of how to think of investors who are potentially large and some of them who could actually have information. And in the empirical setting, I will want to show you some evidence that points to some of the interesting forces that come from the notion of global investors or investments of both active and passive investors in this world. So this is a picture that kind of is one of the main results of the theory piece. So just to give you an intuition, what we really have in mind here is a setting in which we would like to see the consequences of the growing size of passive investors in the market. I think there has been a lot of policy discussion among many players who kind of worry that maybe we are getting too concentrated. Some players such as Vanguard, BlackRock, many others are becoming excessively large relative to the rest of the market. And of course, when things like this happens, there is always a notion that maybe there is some good, but also some bad associated with this particular fact. So the fact that I want to emphasize here are really two forces that are gonna kind of interact with each other. So one force, of course, is gonna be that large players may be more informed because they are actually more able to attract or generate private information. So you may think that from the perspective of welfare, some kind of aggregate informativeness, which is what the left-hand side, what the y-axis of this picture is, that could be good. But at the same time, we also need to understand that kind of classic feedback effect from the Kyle type of equilibria. As these investors grow larger, it's much harder for them to actually act on that information because they are actually affecting prices. So there is going to be an interaction between two effects. One is going to be the effect that these investors are actually large and there is a price impact of their trades, which is of course costly for them. On the other hand, there is going to be an effect of information itself. And so what this picture shows, I think, is an interesting result because it shows that the net effect of these two forces leads to a hump-shaped relationship between the size of the passive sector and the price informativeness. So in other words, what this picture suggests is that there is an interior solution that actually maximizes price informativeness as some kind of value that maybe the social planner would like to care about. And more so, this is a cross-sectional evidence, which is kind of interesting. It turns out that even though the effect is actually kind of hump-shaped from the perspective of the aggregate allocation, it's actually quite different when you look at the individual assets. So I don't want, I know this picture looks a little bit ugly, but let me briefly tell you what it tells you. It's a picture in which we are sorting the world into 10 different buckets in terms of individual assets volatilities. And we are asking the same question, which is what's the effect of the growing size of individual, of the passive sector on the price informativeness of individual assets. And what's important to understand this picture is the fact that the learning incentives of active investors in equilibrium are very much a function of volatility. Investors, active investors in the world, they want to learn about assets which are actually more volatile. So in some sense, the benefits of information flow are actually larger for assets which are potentially more volatile. So these are this asset 9, 10 that you see in the picture. On the other hand, assets which are smaller, they're going to be less attractive from the perspective of the active investors. So by market clearing condition, they have to be more attractive from the perspective of passive investors. So that kind of gives you a very interesting result where in the cross-section of assets that we may think about in terms of price informativeness, there is a very big distinction between who benefits from actually large players and who actually does not. And here you can see a stark kind of negative effect of passive investors on price informativeness for those stocks which are potentially less volatile relative to those which are actually more volatile. So what I wanted to show you now is some empirical evidence that roughly speaking is supposed to talk to some of these forces from the perspective of the global market. So of course, in the global market perspective, we always worry about some kind of endogeneity, that the selection of assets by investors could be correlated with some other characteristics. So what I'm instead going to show you is evidence from an experiment in which we are adding stocks, individual stocks into a global MSCI index. And we are trying to understand what it does in terms of ownership and price informativeness of individual securities. So as you can imagine, because MSCI index is a global index, what it usually does, it actually affects the ownership by foreign investors, but not so much by domestic investors. So this is what you see in these pictures, that as a result of a stock being added to an MSCI index, domestic ownership of this assets doesn't really change, but what you see is a huge inflows of foreign investors into this type of stocks, simply because foreign investors are more likely to track the MSCI global index. So now the interesting question is, what does it actually look like in terms of individual types, meaning active versus passive owners? And what's interesting from this picture is that roughly 75% of the increase in ownership comes from active investors, and the remaining 25% comes from the passive investors, which is kind of surprising, because if you think of something like an index, the common intuition would be that it's largely going to be held by passive investors. But it turns out that there is actually quite a lot of an active component in this type of stocks. And in fact, the active investors may be actually more sensitive to the shocks of stock being added to an index than are passive investors. But of course, the most interesting question here is, what does it do with these stocks that get added in terms of their price informativeness? So this is a picture that shows you what happens to some kind of measure of price informativeness around this fact when the stock gets added to an index. And you can see that as a result of a shock, actually individual stocks that get added, they actually benefit in terms of price informativeness. And of course, the natural question is, who is responsible for that? Is it because we have these active investors who potentially bring in useful information, or is it because it is passive investors who, for example, may bring some kind of monitoring or better governance to this particular stocks? So this is a set of pictures that is supposed to a little bit shed light on this picture. So what this graph is showing you is the effect post that addition on the subsequent performance of investors who are active, passive, foreign versus domestic. And what you can see here is effectively the ones who are actually benefiting the most from this information are the ones who are the foreign active investors. They are the ones who seem to actually make their allocations, which are exposed consistent with where the rents actually from investment are coming. If you look at the foreign passive investors, you see kind of a negative effect. So the investment by passive investors are actually not leading to subsequent good performance of the stocks in which they invest. So one could argue that probably the price informativeness changes that we observe are more beneficial from the active investors than passive. And if you look at the domestic investors, it's still the domestic active investors who have a roughly positive effect on this price informativeness, but clearly not the domestic passive investors. So overall, the picture that we want to paint from this theory and the empirical paper is a kind of negative view of this particular channel, which is, in general, institutional investors improve price informativeness, as some of the research here shows, but it's largely the active investors who are actually benefiting from that. So what I think is important then to realize that a lot of regulatory constraints that are coming on the table, which suggest that we should actually restrict the participation of active investors because passive investment is the way to go, may actually go counter to what you like to maximize, which is the welfare or some kind of price informativeness of this particular assets. And in the end, I think it also matters to a great extent where the capital comes from, whether this is actually an informed or uninformed capital that we are talking about here. Thank you so much.
Thanks very much, Marcin. I know we are a little bit, we started a bit late.
Hi, this is Harsh. Can I ask a question?
Yes. I was just about to say, Harsh has got his hand up. So, yeah.
So I have a quick comment and a question. I know we are late, and it goes back to what Kumar said. So earlier this year in India, we had a debt fund, which was not even an ETF. It was a passive, it was actively managed debt fund. A group of debt funds, 6 debt funds were closed by Franklin Templeton because of liquidity issue. There was no credit event in any of their investment. There was simply liquidity issue, exactly of the kind that Kumar mentioned. And therefore, the issue is really this, that funds, whether active or passive, especially on the debt side, promise much higher level of liquidity than what their underlying investments have. Correct? So there is a liquidity by nature. So for example, debt fund in India promise a one-day liquidity. You redeem today, you get your money in your account a day after or day after tomorrow. Whereas many of the underlying investments are fairly illiquid. Now, so therefore, there was a lot of talk in India how to solve this problem because the debt funds have become very large, whether active or we don't have hardly any. We have hardly any debt ETF. And in one of the discussions, the proposal that I came up, policy proposal, since Kumar mentioned that, is that if you really compare this situation with banking has exactly the same issue, that banks make loans which are illiquid, but they make very high liquidity promise to their depositors. And that this operates to a whole complex mechanism of banking, a very important component of which is the liquidity window run by the regulator. So I had suggested a cooperative liquidity window run by the asset managers themselves, who together will put capital, leverage it, and run a repurchase window so that in the event of extreme stress, when there is no liquidity, this window will buy securities which are illiquid and provide temporary liquidity. Will that, I want to get reaction of the of Kumar and even others to a policy proposal like that.
Kumar?
Thanks, Harsh. Thanks for providing the perspective of what you saw with the debt funds in India. No, I think that's a really really interesting proposal. I mean, this is the way in which we have solved the the liquidity mismatch in the banking sector. And I think what you're suggesting is something similar in the case of other types of illiquid assets, and in particular fixed income securities. I think conceptually I think it's an excellent idea. The question is, what would be that entity? What would be the structure of the entity? Is it something that?
So what I had suggested was a trust, where the asset managers, in proportion of their debt fund corpus, contribute to the equity. That equity gets leveraged. So you put a $2 billion equity, you leverage it 3 times, you create a $8 billion liquidity window, and it runs by a normal liquidity. It has a bid-ask spread. It runs for not for profit, but it provides liquidity, because it's in their collective interest to have liquidity. Because if there is a redemption pressure and run on one fund, it impacts all the other debt funds because NAVs come down. Now, in India, we have a peculiar problem that the liquidity window run by the banking regulator cannot serve any other entities than banks. Otherwise, you could have said the mutual fund could get access to the same liquidity window, but that's by law. So that's why I thought this was an idea of a cooperative liquidity window which we could create.
Harsh, this is an excellent idea. And I think going back to what happened in March, if you think about what the Federal Reserve did in the US, in some ways it sort of built on the idea that you had, because it stepped in as sort of the big buyer out there by providing by giving a promise to provide liquidity, right? That it would buy, and it would buy not just bonds, but it would buy ETFs as well. Including corporate bond ETFs. So I think to some extent, there was a crisis of confidence, and just the fact that the Fed would be around helped resolve that. But in the long run, anticipating that these kinds of runs would come again, what would be the right mechanism? And I think the idea that you propose is really an excellent one that one should think about carefully.
Can I also add, Harsh, my support for that also in the context of fixed income funds? Because in the case of fixed income funds, the pricing of any kind of bond is essentially 3 or 4 factors capture about 95% of value, as distinct from equity, where the value capture is much smaller. So therefore, any kind of cooperative which is doing this would be able to quote reasonable bid offer spreads,
Exactly.
because they will be able to manage risk across a spectrum of securities, not just in that particular security.
So Pradeep, what had happened when I suggested this in a policy meeting, pushback was that why is it that an individual fund cannot repo this or get the bank credits against this its own investment temporarily? And my answer was exactly that. The equity in this vehicle would actually reduce the bid-ask spread quite sharply. And as a result, the funds would not lose money, because otherwise, normally what happens in the stress environment, you can bend bank lines, but haircuts go to the sky. So in the normal circumstances, banks have a haircut of 5%, it will go to 30%, which just makes it completely unviable for the fund to use bank lines against their holdings, even if they are available. So my view is that if there is equity in this vehicle, then that will reduce the bid-ask spread quite sharply in a repo situation.
May I make a comment,
Yeah,
Pradeep? Yeah, I think I like a lot of this discussion, but maybe I would like to throw in a little bit of slightly cool water on the system. I think it's not a matter always whether we can save the system, but I think we also need to think about the cost of that. I think I recognize the fact that the Fed has stepped in and have saved the financial markets yet another time, but I think it's fair to say that this is not an optimal way of actually rescuing the system, because it's extremely costly. I mean, we don't know yet how these costs are going to materialize in the long run, but the numbers we are talking at this point are just staggering. So I think it's important to take that into consideration. And maybe the second comment that's related more to your comment, Harsh, if I may call you this way. I think there is also a notion of ex-ante versus exposed. I think we need to be a little bit careful, because any kind of exposed intervention where you observe the run, it's a pretty difficult one, because there is always a notion of some kind of inefficiency of the rescue. So I think what are probably better, at least mechanisms we would like to think about, are the ex-ante kind of mechanisms that stop the run in the first place, rather than actually we deal with the exposed cost of the run. And kind of directly on the liquidity, if you think about your proposal, it's very much similar to the bank capital kind of story, where we have the capital equity there. But let me just say that I don't think the bank equity itself is enough to contain the runs. We still have the FDIC, at least in the United States and in many other jurisdictions. So if we didn't have FDIC, I think the history tells us that just the bank equity is not enough to actually stop the run. So in this regard, I think it's important to have this in mind, I think.
If I may, the bank equity point is right. I always look at bank equity like airbags in a car. They don't reduce the probability of accident, but they reduce the damage caused by an accident. In terms of ex-ante versus exposed, see, look, my proposal came out of this simple notion that liquidity in these asset market is a public good for asset managers, which means that if one asset manager, which happened in India, went into liquidity-related challenges, then it impacts all other asset managers. And that is why if you did it through a Fed, you make private costs public. That is why I thought it was a cooperative window where all the asset managers have a skin in the game by their own equity contribution and their own in this vehicle. And that's the only way I could make. I'm not saying it's going to solve all the problems. It's not going to solve problems of actually underlying runs. If there is illiquid, if you have bonds that are illiquid, they are going to remain illiquid. But I'm saying the damage that gets caused by illiquidity could be reduced a fair bit through a vehicle like this.
So maybe last comment, and I will stop if I may. So I think Kumar related to that, and I can maybe draw on that from my own research. So in the UK system and in the European jurisdictions, to some extent, you have this swing pricing idea, which is basically this idea of dealing with strategic complementarities. And I've done a paper last year, which actually is interesting because these days it creates quite a lot of interest from the policymakers in the US, which basically showed that when you have swing pricing in the European markets, and that's related to actually bond funds, which are largely illiquid, any kind of big shocks are ex-ante contained much more among these funds that actually swing the price than those that don't. And I think this is, again, I don't want to like speak to my own research, but I think we do find strong evidence that this is actually ex ante much less costly than throwing in capital from the taxpayers' money. It's just a simple idea of containing the strategic complementarities inside the funds. And I think that's maybe one way to think about it differently.
And if I can come in, Harsh, the other problem which arises is you are actually linking the ability to manage money to the balance sheet you have. See, at the end of the day, what you're saying is, you would have to put in capital to manage debt funds in India, wherever you are. So that becomes a problem because that becomes very expensive.
Yeah, I mean, look, we have to trade off, and remember, this is equity contribution. So if the vehicle makes basic return on equity, that's fine. That's still, that's capital, not idle capital. And I'm not talking of very large contributions. I'm saying, let's say 0.5% or 0.1% of your AUM as a capital is not a very large contribution. But my view is that. It's like you'll reduce your annual profit by a 10 basis point. That's fine.
No. I'm not talking about the profits. So what you will encourage is basically only a large player can come into the market. A small player, a new entity cannot just come into the market.
No. They will have support of this vehicle, and their contribution will be to the extent of their equity contribution. They will have the same access to the repo window.
Assume that basically you have 50,000 crore fund.
Can we, I think, draw a discussion to a close because we are over time. And if there is any anything else which anyone wants to say, otherwise we'll close the session. Anything else which anyone wants to make a point on? Well, I guess it remains for me to thank our wonderful panelists, Kumar, Jonathan, Sanjeev, and Marcin. And thanks, Susan, for organizing the conference yet again. And I guess with our 5-day structure, we meet again tomorrow. Tomorrow, we're talking about firm finance, some sessions, and then there is a panel on IPOs.
Yep.
Susan, anything else?
No, we're good. Thanks a lot, Pradeep. So this year we, in the online format, we've given over every session to who we call an enthusiast. Some of us call them mothers. And Pradeep was the first demonstration of how one can support and nurture a session. And I think you did a fantastic job, Pradeep, set a great precedent. And we'll see how the rest of us can match up. Thank you very much. Thank you for all of the researchers who sent in papers, the discussants, and of course, the panelists. I mean, I was hoping to hear a little more about commodity funds because I think that's the cool new area. But the discussion was fascinating. And it always strikes me as fascinating that people are still talking about passive versus active management and new structures with it. I love finance.
You had a whole paper on commodity funds from Jonathan.
Yeah, no, I agree. I mean, but I think that's a really nice and interesting new area where we haven't really started off any of that stuff in a big way in India, but I think it can start. And that would be, I mean, that's a new nascent area to watch for India. I mean, we have specific funds like gold funds, but not commodities, and that would be fun. Anyway, the world evolves.
Interview tomorrow is Yesha Yadav.